Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at energy fuels, ticker UUU.
If you find our talks useful, please consider subscribe, like, and comment underneath, and make sure to check out the VIP Algos link below in the description.
Yeah, definitely check that out. So today's focus is on a company that, honestly, it kind of breaks all the traditional wealth building rules.
Oh, completely. Imagine you're looking at a company's financial profile,
Right.
and they are operating at a total loss.
Yeah. Deeply negative margin.
Exactly. I mean, they are actively burning through cash just to build out their infrastructure. By almost any traditional metric, you'd flag this as a massive high-risk liability and just walk away.
Right. You wouldn't touch it.
But then you glance at the stock chart and you see it's skyrocketed over 200% in just a single year.
Which is wild.
It is. And if that isn't baffling enough, the Pentagon, like the actual U.S. Department of Defense, recently stepped in and offered them this massive conditional $725 million loan.
It's a profound market paradox, honestly.
Mm-hmm.
You're looking at a balance sheet that currently resembles basically an expensive construction site.
Yeah.
But it carries this huge valuation and a level of federal government backing that treats it like, an irreplaceable national treasure.
And that paradox is exactly what we're unpacking today. Our mission for this talk is to really figure out the mechanics behind this anomaly.
Right.
Like, how does a currently unprofitable mining operation become the absolute darling of both Wall Street and the military?
Well, to really grasp what's happening with energy fuels, you kind of have to temporarily put their current revenue aside.
Okay, ignore the current numbers.
Exactly. You have to look at the macroeconomic tidal waves that are just forcing the hands of the largest tech companies and military powers in the world right now.
So let's start with the most aggressive tidal wave, which is obviously the artificial intelligence boom.
Oh yeah, the AI squeeze.
Right. When you read about AI, the focus is almost entirely on the software side, right? The sophisticated algorithms, the large language models, the cutting-edge semiconductor chips.
Which are important, sure.
They are, but what gets completely glossed over is the physical mechanism required to actually run those algorithms. I mean, AI is incredibly, just unsustainably hungry for electricity.
The sheer physics of these AI data centers is, it's actually difficult to comprehend. We aren't talking about upgrading a few server racks here.
No, not at all.
We are talking about facilities that require hundreds of megawatts of continuous power. I mean, a single ChatGPT query requires nearly 10 times the electricity of a standard Google search.
10 times, wow.
Yeah, and when you scale that up globally, you are pushing entire regional power grids to the absolute brink of failure.
And this is where we have to talk about the nature of that power, Think of AI data centers like a fleet of hypercars.
Okay, I like that.
Right. And you can't just put cheap gas in a hypercar. You can't just throw up a massive solar or wind farm next to an AI data center and call it a day.
No, because those sources are intermittent.
Exactly. If the wind stops blowing or it's a cloudy week, the power output drops. But an AI data center is like this massive artificial brain.
Yeah, it has to run constantly.
Right. If it loses power for even a fraction of a second, the operational and financial losses are just catastrophic. They require what we call baseload power, massive, reliable, 24/7 electricity that just never fluctuates.
Which basically eliminates most renewables for this specific use case.
Right. Yeah.
And that leads tech giants directly to the doorstep of nuclear energy.
Yeah.
More specifically, they are looking at small modular reactors, or SMRs. For years, SMRs were basically just a neat engineering concept on a whiteboard.
Like science fiction almost.
Basically, yeah. Think of them as scaled-down versions of the nuclear reactors used in submarines, but designed to be manufactured in a factory and assembled on-site directly next to a data center.
So they completely skip that decade-long construction nightmare of a traditional nuclear plant.
Precisely. And now, these SMRs are moving rapidly from theory to actual signed contractual reality. Tech companies are funding their deployment because it's literally the only zero-carbon way to get that baseload power.
But for any of these reactors to function, they need one extremely dense fuel source, which is uranium.
Exactly. Uranium is the high-octane fuel for your hypercar analogy.
And that creates an incredibly rigid demand floor. According to the data we're looking at today, this guaranteed future demand from both traditional reactors and new SMRs, it establishes a base case where uranium prices sit between $85 and $105 per pound.
Right, that's just the baseline.
Yeah. In a bull case scenario where the AI build-out accelerates even faster, we could see prices surging well past $150 a pound.
But the macroeconomic setup isn't just about feeding the power grid. It's also about the raw materials required to build the hardware itself.
Oh, like the actual servers and cooling systems?
Yeah. The servers, the EVs, the advanced defense systems for the military, they all require something called rare earth elements. These are specific minerals used to manufacture highly specialized, incredibly powerful, permanent magnets.
And that introduces a terrifying geopolitical bottleneck, doesn't it? Because the supply chain for processing those rare earth elements into usable magnets is overwhelmingly dominated by China.
Overwhelmingly.
Yeah.
And the U.S. government views that bottleneck not just as an economic issue, but as a critical national security vulnerability.
I mean, it makes sense.
Right. If relations deteriorate, China could theoretically just cut off the supply of the very materials we need to build advanced military hardware and domestic tech infrastructure.
Which would be disastrous.
Absolutely. So there is an urgent, almost panic push to reshore these supply chains, to get the processing out of China and back onto U.S. soil.
So just to recap the wealth-building context here, we have a desperate need for domestic uranium to power the AI boom, and an equally desperate geopolitical need for domestic rare earth processing to build the hardware.
It's exactly. Two massive trends colliding.
Which naturally leads to the question, if these materials are the ultimate bottlenecks, who actually has the physical capacity to refine them here in the U.S.?
And that brings us to the core of Energy Fuel's physical moat, which is the White Mesa Mill in Utah.
This facility is basically the linchpin of the whole story. It's a 45-year-old mill, but it holds a really unique distinction. It's currently the only conventional uranium mill operating in the entire United States.
Yeah, the only one. And that monopoly isn't just a fun piece of trivia, you know? It is a structural barrier to entry for any competitor.
Because processing uranium isn't just digging rocks out of the ground.
Not at all. It is an intense chemical refinement process. It involves crushing the ore, acid leaching, and complex chemical precipitation just to extract the radioactive material safely.
And getting permission from the government to do that kind of chemistry is nearly impossible today. I mean, if a rival company wanted to build a new conventional uranium mill from scratch, the environmental permitting process alone would take decades.
Decades, easily.
You're dealing with intense scrutiny over water contamination, radioactive waste disposal, local zoning laws. You'd burn through billions of dollars in legal and environmental studies before you even broke ground.
Assuming you didn't get blocked entirely, which happens a lot.
Right.
So the fact that Energy Fuels already owns this fully permitted, fully operational infrastructure is a huge strategic advantage. It basically cannot be replicated in our current regulatory environment.
And they aren't just processing uranium anymore, right?
Exactly. They've developed a multi-commodity capability. Under one roof, they're co-processing uranium, a metal called vanadium, and now rare earth elements.
Which is a massive efficiency play. By sharing the overhead costs of the mill across multiple valuable commodities, their processing costs drop dramatically. The financial reports show historically low processing costs between $9 and $12 per pound for uranium oxide. And their stated goal is to build a mine-to-magnet supply chain that is completely independent of China.
Right, that's the dream scenario.
Yeah. But looking at the fundamentals, there is a glaring contradiction here.
Let me guess. The unprofitability.
Yeah. If they hold a virtual monopoly and their processing costs are incredibly low, why are their margins deeply negative? Like, why is the company currently unprofitable?
It's the essential question any investor has to reconcile right now. The answer lies in the difference between operating a business and transforming one.
Okay, how so?
Well, Energy Fuels is currently in the middle of a massive, capital-intensive build-out phase. They are retrofitting a 4.5-decade-old uranium mill to also act as a world-class rare earth separation facility.
They're essentially tearing the engine out of an airplane and upgrading it while the plane is still flying.
That's exactly it. The sheer capital expenditure required to install new chemical extraction circuits and modernize the facility is totally eclipsing whatever revenue they're generating for their current operations.
So it's a short-term pain for long-term gain situation?
Precisely. That transformation is incredibly expensive. Management fully expects their overall cost of sales to decline significantly by 2026 as they finish the build-out. But for now, every spare dollar is being poured into building this integrated machine.
And you definitely see the strain of that build-out when you look at their raw numbers. They're pulling in about $65.9 million in revenue, but as we noted, the margins are negative and their free cash flow is heavily suppressed by this rare earth expansion.
Yeah, the cash burn is real.
However, when you pivot and look at their balance sheet, It looks unusually secure for a company burning this much cash.
It really does. For a development stage critical minerals company, their balance sheet is a fortress. They have zero long-term debt.
Zero, which is incredible. And they have a current ratio sitting above 30.
Yeah, that 30 number is huge.
Let's break down why that specific metric matters so much. A current ratio basically measures a company's ability to pay off its immediate short-term debts using its most liquid short-term assets like cash or easily sold inventory.
Right.
So if your ratio is a 1, you have exactly enough money to pay tomorrow's bills. A healthy company usually sits around a 2 or a 3.
So a current ratio above 30 means Energy Fuels is sitting on 30 times the assets needed to cover its immediate liabilities. It's just a massive, highly unusual liquidity buffer.
But even with that buffer, funding a massive infrastructure overhaul eventually drains the bank account.
Right. You can't run on savings forever.
Exactly. And that is why the recent catalysts completely changed the calculus for this company. The U.S. Department of Defense's Office of Strategic Capital stepped in with a conditional financing commitment of $725 million.
And that fundamentally alters the risk profile of the entire company. This is a 20-year loan facility specifically designed to provide the heavy, long-term capital needed for this project development.
Think about the mechanics of how companies usually raise money when they are unprofitable, right?
Wow.
If a company needs $700 million to build a factory, they often have to issue millions of new shares of stock to the public.
Yes, the dreaded dilution.
Right, dilution. If you, the listener, own 10% of a company, and the company suddenly doubles the amount of stock in existence to raise cash, your slice of the pie just got cut in half. Your shares are worth less.
Dilution is literally the single biggest fear for investors in the mining and development space.
Yeah,
It can wipe you out.
exactly. So this Pentagon loan acts as a massive financial cosigner. It gives Energy Fuels the capital to complete their vision without having to print millions of new shares and devastate the value for existing shareholders.
And the analysts covering the stock recognize this massive shift. They're looking at the current unprofitability and modeling right past it.
Oh yeah, the earnings turnaround forecast is pretty stark. The consensus estimate forecasts a loss of 14 cents per share in 2026, but then projects a massive reversal to a profit of 9 cents per share in 2027 once the heavy lifting is done.
Because the market instantly recognized that the U.S. government effectively just underwrote the most expensive, riskiest part of their business plan.
And the market sentiment reaction was violent in the best way possible. Following the loan announcement, the stock popped over 16% in pre-market trading alone.
Yeah, it gapped up hard.
If you zoom out to a one-year chart, Energy Fuels has gained over 206%. To put that in context, the broader industry average is up roughly 74%, and their closest rare earth peer, MP Materials, is up about 61%.
Energy Fuels is basically lapping the competition right now.
But, buying into that kind of momentum means you're paying a very steep premium on the technicals. If you look at the forward price to sales ratio, it is trading at nearly 23 times.
22.8 to be exact.
Let's clarify why that's a red flag for traditional valuation. The price to sales ratio compares the company's stock price to its revenues. A forward PS means you are valuing the company based on the sales they hope to make next year.
Right, future sales.
And the industry average is trading at roughly 5 times forward sales. So investors in Energy Fuels are currently willing to pay almost $23 for every single dollar of revenue the company expects to make next year.
It is an astronomical valuation. And it's exactly why the stock currently carries a Zacks rank of 3, which is a neutral rating.
Right, a neutral stance from the analysts there.
Mathematically, based on current cash flows, the stock is wildly expensive. Wall Street has categorized this as a story stock.
Meaning nobody is buying this stock because of the money they made last quarter.
Exactly. They are buying the narrative.
They are buying the thesis that the AI energy bottleneck and the geopolitical mandate to ditch Chinese supply chains are just unstoppable forces. They're paying a premium because they believe Energy Fuel's success is a matter of national necessity, not just corporate strategy.
And that narrative is going to be tested by some very real, tangible milestones coming up. The first big checkpoint is mid-year 2026. By June 30th, they are expected to hit a production milestone of 1.6 million pounds of finished uranium.
Which is huge, since their full-year guidance sits between 1.5 and 2.5 million pounds. Hitting that mid-year mark is critical. It proves to the market that the physical reality of the mill is actually matching the story.
But there's also a massive speculative catalyst in the background regarding mergers and acquisitions.
Oh, right, the ASM deal.
Yeah, there is active chatter about Energy Fuels acquiring an Australian company called ASM, or Australian Strategic Materials. And this is a crucial piece of the puzzle.
Why is that?
Well, we talked about how rare earth elements are used to make permanent magnets, right? But you don't just take the chemical powder produced at the White Mesa Mill and instantly get a magnet out of it.
Right, there are more steps.
Exactly. The separated rare earth oxides have to undergo a chemically brutal process called direct metallization to be turned into actual metal alloys.
It's the final and often most complex bottleneck in the supply chain.
Right now, ASM already has those direct metallization and alloying capabilities up and running in South Korea. Yeah. So if Energy Fuels successfully buys them and all the shareholder approvals go through, it is a monumental leap forward. They don't have to spend 5 years and millions of dollars figuring out how to build the metallization step from scratch.
That saves so much time.
They acquire ASM, plug that South Korean facility into the end of their U.S. pipeline, and boom, their mine-to-magnet supply chain is instantly complete.
So if we recap the upside here, you have a company trading at a massive premium, sure, but it is backed by a $700 million Pentagon loan sitting on an irreplicable monopoly asset, benefiting from the AI nuclear boom and potentially buying its way past the final supply chain bottleneck.
It paints a picture of inevitability.
It really does. But let's ground ourselves. Let's look at the risks. What does the bear case look like? Where are the fault lines in this thesis?
The most glaring fault line is right at the top of the DoD loan document. It is a conditional commitment.
The key word being conditional. It is not a wire transfer that has already cleared the bank.
Not at all. It is entirely subject to final, exhaustive due diligence by the federal government.
And government audits are no joke.
Exactly. If the auditors find something alarming in the environmental history, or if a new political administration suddenly shifts critical mineral priorities, that loan could evaporate overnight.
And if that funding falls through, we are right back to the nightmare scenario of dilution.
Yep.
Energy Fuels would likely have to issue massive amounts of equity to keep the White Mesa retrofit alive, which would aggressively dilute current shareholders and just crush the stock price.
Now, their current ratio of 30 plus provides a nice cushion, right? They wouldn't go bankrupt tomorrow.
Sure.
But the multi-year growth thesis is entirely tethered to that federal capital coming through.
Another risk that could severely rattle retail investors is the operational timeline. The reports explicitly highlight a planned pause in all uranium processing during the fourth quarter of 2026.
And this is going to be a fascinating psychological test for the market. To finalize the Phase 1 rare earth element modifications, they physically have to stop the mill.
They just have to shut it off.
Yeah, they need to rebuild their ore stockpiles and install the new circuitry.
It's the highway expansion dilemma.
How so?
Well, if you want to add 3 new lanes to a major interstate to fix a permanent traffic jam, you have to completely shut down the highway for a weekend to do the heavy construction.
Right.
It causes a massive, painful traffic jam for 2 days, but it solves the bottleneck for the next decade.
That is a perfect way to look at it. But the danger is how the market interprets that closure. When Q4 2026 earnings are released, algorithmic trading bots and retail investors who haven't read the deep analysis are just going to see headlines screaming, "Energy Fuels halts production," or "Revenues plummet in Q4."
Oh, people will panic.
There is a very high probability of a panic sell-off by people who think the company is failing, when in reality it's a highly telegraphed, necessary upgrade.
But even after they finish that upgrade and turn the massive new mill back on, they run into a raw material problem. They need something called monazite sands to feed the machine.
And this is the feedstock supply risk. A world-class separation facility is only economically viable if you can run it constantly.
Right.
To do that, you need a massive, uninterrupted flow of raw material. In the rare earth world, one of the best sources is monazite sand.
For those unfamiliar, monazite sands are heavy mineral deposits that are incredibly rich in rare earth elements, but they have a catch, right? They are also naturally radioactive because they contain high levels of thorium and uranium.
Which is exactly why the White Mesa Mill is the only place equipped to handle them. Normal refineries can't legally or safely process radioactive sand.
Right.
Energy Fuels has the permits and the chemical circuits to extract the rare earths and safely recover or dispose of the radioactive byproducts.
But securing enough of this specialized sand globally is difficult. If global logistics break down or a mining partner defaults on a delivery contract, Energy Fuels could be left with a beautifully modernized, multi-million-dollar refinery, just sitting idle, burning cash on maintenance.
To their credit, management is actively mitigating this risk. They have secured several offtake agreements to guarantee a steady influx of monazite.
That's smart.
And furthermore, they're using their multi-commodity setup to blend very high-grade ore from their Pinyon Plain mine with lower-grade material from their La Salle complex.
So they mix it.
Yeah. By mixing the materials, they optimize the chemistry and maintain a very respectable average production cost of around $36 per pound. But if the macro supply chain seizes up, their domestic moat won't matter.
So, drawing all of this together, we've examined the massive electricity demands of AI, the geopolitical urgency to secure rare earth magnets, the unique chemical monopoly of the White Mesa Mill, and the sheer financial weight of the Pentagon's conditional loan.
Yeah, a lot of heavy factors.
We've also weighed that against a sky-high forward valuation, the looming threat of equity dilution if the loan fails, and the very real feedstock bottlenecks. Looking at the aggregate of the financial numbers, what is the final verdict here?
The consensus distills down to an 8 out of 10 bullish score. It is a highly convicted rating, but it requires a very specific type of investor.
It requires an investor with a long time horizon.
Exactly. This is universally viewed as a multi-year investment horizon. This is a structural play on the reshoring of the U.S. industrial base. It's driven by macro-level commodity bottlenecks that take years to resolve.
You can't just expect overnight returns.
No, you have to possess the psychological patience to hold the stock through the inevitable operational choppiness like that Q4 2026 production pause we talked about.
Right.
And you have to wait for the Phase 1 rare earth modifications to come fully online in late 2027 and early 2028. That is the point when the massive capital expenditures drop off, the new revenue streams activate, and the earnings trajectory is projected to truly reverse into profitability.
It is a fascinating story of immense future potential, temporarily weighed down by the heavy, messy reality of physical construction and government audits.
Very messy.
Which leaves us with a final, lingering thought to explore. We have spent this whole talk detailing how a conditional $725 million loan from the U.S. military fundamentally reshaped the valuation and safety of a publicly traded mining stock.
It effectively put a floor under the company's risk profile.
But think about the broader implications of that. If the U.S. government is now willing to step in and act as the ultimate institutional investor to secure these critical minerals, what does this mean for the future of free market mining?
It really changes everything.
It does. If a company's traditional balance sheet doesn't matter nearly as much as its strategic value to the Pentagon, does the urgent need for national security and AI dominance completely rewrite the rules of how we value a business?
It's a great question.
Suddenly, the traditional financial metrics we use to diagnose a healthy company are looking very different. It is definitely something to keep in mind as you watch this new era of state-backed infrastructure evolve. Well, that wraps up our analysis on energy fuels. Don't forget, if you find our talks useful, please consider subscribe, like, and comment underneath.
And make sure to click the VIP Algos link below in the description to take your trading insights even further.
We'll see you next time.